Okay, so financial technology, fintech, I mean, it's been reshaping the world of money and accounting for quite a while now, hasn't it? Automating things, really changing the game.
Absolutely, yeah. And maybe one of the most talked about results of this whole fintech revolution is, cryptocurrencies.
Right.
You've definitely heard of Bitcoin, I imagine, and maybe some of the hype around its early big gains.
Oh, yeah. Those stories. Massive wealth 1 minute, huge crashes the next. They always grab headlines. But if we step back from all that noise, what are these things actually, at their core? And what's the source material telling us about their real impact, how they're being used?
Yeah, that's exactly what we're digging into today. Using the material we've got here as our guide, we want to get our heads around cryptocurrencies, not just as like digital cash, but as this potentially disruptive technology.
Okay.
So we'll look at what they are, their unique structure, and how they're actually working out there today, as ways to maybe get finance short or long term.
All right, let's unpack that.
Yeah.
So at the most basic level, the source says cryptocurrencies are digital assets. Kind of like normal currency, representing value you can exchange, but no physical coins or notes. Just, digital code.
That's the starting point, yeah.
Okay.
Having that specific bit of code basically gives you the right to use it or swap it for other digital assets or sometimes goods and services.
Which, on the surface feels a bit like using a credit card online, maybe, or just online banking.
It's similar, yeah.
But the source is really clear that while the exchange part might seem familiar, the way the whole system works underneath is fundamentally different.
And this is where it gets really interesting, I think.
Yeah.
Because it just flips the traditional model completely. Think about, regular money dollars, euros, pounds. They all rely on a central banking system.
Right. A central authority.
Exactly. There's a central bank, a central record of all the transactions, often processed through these layered, sometimes quite manual systems. One main authority, one main set of books.
One point of control, essentially.
Precisely. Now, contrast that with crypto. The key difference, the really disruptive part that the source highlights, is that there is no central bank. No central records, no single authority figure.
Okay, hold on. If there's no central record keeper, where does the information live? Like, who owns what? Who sent crypto to whom? How is that tracked?
That's the magic, or maybe the tech, of the distributed ledger system.
Yeah.
Instead of one big central database, imagine copying that database thousands, maybe millions of times.
Okay.
And putting a copy on every single computer that's connected to that specific cryptocurrencies network. There's no single master version controlled by one group. It's distributed.
So wait, every single person participating, their computer has a full copy of all the transactions? That sounds huge and very different from a bank server.
It is. And it totally changes the idea of trust. When you make a transaction, say, send some crypto, it's not a bank manager somewhere approving it. It's authorized by what's called a consensus mechanism across the whole network. All the computers basically validate the transaction using complex crypto rules, and they have to agree it's legit.
Like a big automated network vote?
Kind of, yeah. A decentralized agreement. And once that agreement, that consensus is reached, every single copy of that ledger on every computer gets updated almost instantly with the new transaction.
Wow. And the source mentions a big security plus there, right? A central database is one target for hackers. But this distributed ledger...
Well, yeah, think about it. To cheat the system, you'd have to successfully hack and change the records on a huge number of those computers, all at pretty much the same time. The source calls that a nearly impossible task.
Okay.
So this distributed consensus thing basically replaces the trust we put in, say, a bank with trust in the math, the cryptography, and the sheer spread out nature of the network.
That lack of reliance on one bank or even one government that might become unstable, that sounds like it dodges some big risks in traditional finance.
It potentially does. The source lists a few benefits that come right out of this decentralization idea. Because it's not tied to one specific country's bank or government, which could, collapse or face huge instability.
Yeah.
It can mean reduced currency risk, especially if you're dealing internationally or living somewhere with a shaky economy.
And you're cutting out the middleman, the bank fees and all that.
Potentially, yes.
Yeah.
You might avoid some bank or regulatory transaction fees. Plus, the source suggests it could make business easier with people globally, kind of skipping over some traditional banking hurdles and delays.
So thinking about someone in a country where the local money is, losing value fast, could crypto actually be a safer place to hold value?
That's one of the arguments, yeah. The source does suggest it could offer a more stable alternative in those situations, precisely because its value isn't directly tied to that one potentially unstable local economy or government decisions.
Okay, so some powerful potential upsides there, mainly around decentralization, avoiding gatekeepers. But, and it's a big but, isn't it? The source is also very clear this is still pretty new territory, and crucially, largely unregulated.
That is the massive flip side, yes. And the rules, the regulations, they're all over the place globally. It creates this really complex, sometimes quite risky picture.
Just how different are we talking, according to this?
Oh, wildly different. Take China, for instance. The source says they've taken a really hard line, actually made crypto exchanges illegal.
Illegal, wow.
Yeah, but then you look at Japan, and they've gone the other way, moved towards quite progressive regulation, even recognizing some cryptos as legal tender.
So literally from outlawing it to treating it like actual money.
Exactly. And that inconsistency isn't just between countries. Even within the U.S., for example, the laws can vary quite a bit from state to state. There isn't one single federal rule book for using crypto.
What about the UK's approach?
The UK is kind of in the middle, like many places. The source says cryptocurrencies aren't legal tender there, so businesses don't have to take them. Using them isn't really covered by specific laws.
But exchanges are okay.
Yes, running a crypto exchange is legal, but they have to register with the Financial Conduct Authority, the FCA, and follow anti-money laundering rules.
Yeah.
So some oversight, but not full regulation like traditional currency.
Right. So this patchy, often non-existent regulation mixed with the anonymity that comes with the blockchain tech. That sounds like a recipe for some serious risks, doesn't it, for users and maybe everyone else?
It absolutely does. The source points out several big ones. Firstly, with no central boss, basically there's a real lack of accountability built into the system itself. Makes it very tough for law enforcement to step in effectively if things go wrong.
So if the network messes up or someone scams you within the system, who do you complain to?
Exactly, which leads to the next point. A lack of consumer protection. You know how bank deposits are often insured up to a certain amount?
Yeah, deposit insurance.
Well, there's generally no equivalent for crypto. If an exchange gets hacked and your funds disappear, there's usually no collective insurance pot to cover those losses. With your bank account, there are usually ways to try and get money back if it's compromised. Much less clear here.
And the risk isn't just about big exchange hacks, is it? It's personal, too.
Oh, very much so. The source flags the risk of simply losing your funds because you lose your private key. Think of it like your super secure password or digital signature.
Okay.
Unlike a bank account tied to your name, address, ID, crypto ownership is often just tied to holding that key. If you lose the key, forget it, delete it by mistake, whatever it can be incredibly difficult, maybe even impossible, to prove you own the crypto and get it back.
Like losing the only key to a digital vault and there's no locksmith.
That's a good way to put it, a really chilling thought if you hold a lot of value that way.
What about those broader societal risks people talk about, like crime?
Well, the source notes that because these transactions happen outside the normal banking system, and they can be complex and hard to track clearly, it does increase the risk of things like tax evasion. It's just potentially easier to forget to report these transactions.
And unfortunately, that same privacy feature makes them attractive for more serious stuff, too.
Yes, the source does state that the high confidentiality and the difficulty in tracing funds can, unfortunately, make cryptocurrencies useful for things like money laundering or paying for illegal goods online. It definitely makes it harder for authorities to follow the money.
So, okay, despite the promise of decentralization, these issues around regulation, security, losing your keys, illicit use, they're still major hurdles, big concerns.
They really are.
Yet the source still says overall crypto use is going up.
It does, yeah. Which is interesting. And while the initial idea might have been using them like frictionless digital cash, for buying coffee or whatever, the source actually points out several big drawbacks that are limiting that right now. Most retailers just don't accept them. Their value bounces around like crazy, super volatile, making them unreliable as a store of value day to day.
Right, your crypto might be worth much less tomorrow.
Exactly. And as we said, in many major economies, they aren't legal tender, so businesses have no obligation to take them as payment.
But even with those issues, there are some benefits to using them for transactions, aren't there? If you can use them.
Oh, sure. Potentially, transactions can be faster and cheaper because you're cutting out some of the banks and payment processors in the middle.
Fewer intermediaries.
Right. And the decentralized system itself might be more robust, less likely to have an outage than maybe a single bank's online system.
Yeah.
More stable platform, potentially.
But here's the really interesting thing. You mentioned a trend the source highlights about using them as, well, money, a medium of exchange.
Yes, this was fascinating. Despite those potential transaction benefits we just listed, the source actually indicates that their use as a medium of exchange for buying stuff is currently declining.
Declining? Really? So people aren't using them to buy pizza or pay bills as much as maybe they were, or as much as the hype suggested.
That seems to be the picture painted by the source, yeah. It looks like users are shifting. Their main interaction now seems to be holding crypto more as an investment, speculating that the price will go up.
Okay. Which brings us neatly to what seems like their biggest use case right now, investment. Driven, like you said at the start, by those crazy stories of huge gains, like that Bitcoin bubble back in 2017.
Absolutely. They're traded on special crypto exchanges, which work kind of like stock markets,
Right.
trading platforms for different coins.
Okay.
And this does potentially open up new kinds of investment opportunities to more people, things outside the traditional stock and bond markets.
But all those risks we just talked about, the lack of regulation, the security issues, they feel especially sharp here, don't they, in the investment context?
Oh, they're critical. Paramount. Investing in crypto carries significant risk, no doubt about it, and that risk is amplified precisely because the regulation is so inconsistent or non-existent globally.
So the potential for losing money is high.
Very high, yes. The potential for rapid loss is extremely real. I mean, that 2017 bubble bursting in early 2018 showed that clearly. Prices just plummeted.
And that anonymity aspect comes back in again here too.
It does. That user anonymity, while maybe good for privacy in some ways, also unfortunately increases the risk that these investment platforms themselves could be exploited for money laundering or other financial crimes, potentially dragging unsuspecting investors into murky waters.
Okay, lastly, the source gets into how cryptos are used to actually raise money for new ventures, these initial coin offerings, ICOs.
Right, ICOs.
Yeah.
It's basically a way for a new project or company to raise capital. They create their own brand new cryptocurrency token tied to their project and sell it to supporters to get funding, usually on a decentralized network.
The source compares them to traditional IPOs, initial public offerings, right? When a company first sells shares on the stock market.
It draws the comparison, yeah, but mainly to highlight the crucial differences. And the risks involved are quite different.
Okay, so how is buying into an ICO really different from buying shares in a company going public? Let's connect that dot.
Well, first off, the source often calls the people buying into ICOs supporters, not just investors. It's sometimes framed a bit like crowdfunding. You're backing a project you believe in.
Okay, like Kickstarter, but you get digital tokens instead of a product.
Sort of, yeah. But instead of just donating, these supporters get tokens in the project's new currency, with the hope that these tokens will become valuable later if the project succeeds.
Got it. Back the project, get their coin.
Right. Now, a key difference again is that decentralized thing. There's usually no single controlling authority overseeing the actual ICO process itself.
Which, based on what we said earlier, immediately screams regulation issues.
Bingo. Exactly.
Yeah.
IPOs are heavily regulated. Strict rules about what companies must disclose, legal protections for investors. ICOs, on the other hand, are, as the source points out, largely unregulated pretty much everywhere.
And that opens the door for...
Well, it significantly raises the risk of outright scams, projects that just take the money and run. These scams often target people who maybe don't fully understand the tech but are lured in by promises of ridiculously high returns.
And the thing you're actually buying is fundamentally different too, isn't it? A token versus a share.
This is probably the most critical distinction the source makes, yes. When you buy shares in an IPO, you're buying a piece of an existing company. Those shares usually have some kind of inherent value linked to the company's actual assets, its profits, its business operations.
Okay, tangible backing, sort of.
Right. But in an ICO, you buy tokens for a new currency tied to a new or maybe still developing project or system. And the source is very clear. These tokens, initially, have no inherent value. None.
No inherent value, wow.
Their value is purely speculative. It only becomes real if, and it's a big if, the underlying project actually succeeds, gains users, finds a purpose, and people start wanting those specific tokens.
That is a massive difference in risk profile compared to buying a piece of an established company.
It really is. It underlines just how speculative many ICOs can be. And just as a final point the source mentioned on this, the worries about ICOs were so big that China actually banned them completely back in 2017.
Right, okay. So quite a journey through the crypto landscape, using the source material as our guide. We started with the basics digital assets, this unique distributed ledger system.
Fundamentally different from central banks.
Yeah. Then we looked at the potential upsides of that decentralization, maybe lower risk in some ways, avoiding fees.
But then we had to face the very real downsides and risks, the big gaps in regulation globally, the danger of losing your keys and your funds.
Yeah.
And the potential misuse for illicit activities. That's all still very much part of the picture.
And we saw how their use as actual day-to-day money, a medium of exchange, seems to be, perhaps surprisingly, declining.
Right, with the focus shifting much more towards holding them as a pretty volatile investment.
And finally, we unpacked their role in raising funds via ICOs, really stressing those key differences from traditional IPOs, especially that initial lack of inherent value in the tokens.
Yeah, understanding all these different pieces, the tech, the pros, the cons, the current uses, it's really vital, isn't it? For anyone trying to navigate this fast-moving fintech world, whether, you're prepping for a meeting about it or you're just trying to understand where digital assets might be heading.
Absolutely. So here's something to maybe chew on after this, building directly on what we've discussed from the source. Think about that fundamental difference we just highlighted. Buying shares in an IPO gives you a slice of something with existing underlying value, a company. Buying tokens in an ICO gives you something with no initial inherent value, banking entirely on the future success of a brand new, often unproven, decentralized idea. Given that core distinction, alongside the messy global regulation and all the risks we talked about, what does that tell you about the true nature of investing in this particular space right now? What are you really buying into?